Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm always here to help you maximize your cash flow. Today we're going to talk a little bit about 529 plans, compare them to whole life insurance, because of a question one of you guys left me in the comments section of a video. I appreciate that. This is Kareen says, James, would you be willing to consider making a video on a comparison of 529 funds versus whole life? Would love to hear logic and reasoning. Good question. We have talked about 529s traditionally in relation to IULs and where my preference lies. Spoiler alert, I do prefer the IUL. Most of the time, the reason we're looking at comparing IUL and 529 is because of the risk that a 529 plan represents. You're actually invested in the stock market in those plans, and you could potentially lose the value of it. The reason you would want to do that in the first place is because of the tax advantages, but also the growth potential. But I think the tax advantages are like the number one draw. Sometimes those accounts are only going to be funded for a handful of years before a child gets to college. Some people are fortunate enough to get it started right out of the gate when their child is first born, and they may have 18, 19, 20 years in order to let growth happen. The natural inclination, if somebody's already looking at being in the stock market, but they like the appeal of getting some tax advantage growth and not being exposed to the downside, that's where the IUL comes in. So normally we do a comparison on the IUL, and I believe I have some videos about that. I will link that video up here if I can track it down. Should be one on my channel. So let's talk whole life and 529s. Some things to understand about the 529s is 529s do generally carry some good tax advantages. In general, I'm a fan of utilizing tax advantaged products or tax advantaged places for us to keep our money and grow our money. In the case of the 529, one of the big draws is you're going to put after-tax dollars into it, and it's going to grow tax deferred. And if you use those funds for education purposes, you get to use them tax-free. So it ends up functioning very similar to a Roth. Big difference between that and a Roth is a Roth, you don't have to use it for education purposes. And all of the money that comes out of it after retirement ends up being tax-free. That's good, unless you need to pull it out before retirement to serve some education expenses. And then you might want to look at something else. Instead of putting that into a retirement account, you want to put it into something else that you can get access to it before retirement without penalties, or at least access to the gains. Now, we can't put a whole lot of money into a Roth anyways, at least not directly. There are some ways to get backdoor contributions that might end up being bigger. But 529s essentially help to meet a need where somebody might want money that's exposed to the stock market, and you get tax advantages to go along with it. So tax advantage for the growth and potentially pulling it out tax-free. In addition to that, there's some states that will give you some tax advantages. Maybe you might be able to save on your income taxes for state taxes in certain states up to a certain amount. So that's something to look into. If you can get a tax credit, I know there's at least one state out there where you can get a tax credit for money that you're putting into a 529 up to a certain point. That's a good argument for using that up to that certain point. Even in addition to where I'm going to advocate for, maybe we look at using life insurance to help meet some of these education needs. That's the arguments for the 529s. The arguments against the 529. The 529 in and of itself, the values get reported on the FAFSA. So it's not going to save if you are going for scholarships or grants. Those funds are going to be used as part of your income, as part of your net worth. In addition, we're talking about a short funding period. You're not necessarily going to go very aggressive inside of that account in order to get some good growth. You might have target date funds that you're going to utilize. You might have a whole host of options for certain ones that you might utilize. But are you going to be able to manage that properly so that you have the right risk exposure depending on how close you're getting to college? You don't really want to risk losing 50% of the value of the account a year or two before they're ready to go to college, because that could severely impact what you have available to get them to college compared to what you expected to be available. And Yeah, sometimes the market will lose 50%. So we've got to be careful with that. So most likely, your most aggressive years are going to be the early years. And those early years happen to be the years where we have the least amount of money inside of those 529s. When you have the most amount of money in it, that's when you need to have the most conservative years. So you might go from a potential returns of, 10 or 20% in the early years, and in the later years, you might just be getting 1 or 2 or 3%. Some smaller, safer amount that it's not at risk of dropping 50%. Looking through some of the funds at Fidelity, you've got a number of funds out there and you can see their 10-year returns. Some of those safer portfolios in there that you're probably going to diversify into, their 10-year returns are in the 1 and 2% range. That's okay. That's kind of what you need to do if you're going to be exposed to the stock market on something that you're going to need access to in a short period of time. Now, life insurance, the cash value in life insurance, and traditionally this is an IUL, why we compare it to that. But whole life works very similar to IUL. We just have different crediting. The crediting in an IUL is going to be based on the growth in an index. There's the potential that you could get good growth in any given year, but it's downside protected. You're not going to lose money based on the market returns, but you will still have the cost of the insurance each year. So as long as we're funding it at a level that covers the cost enough and gets us growth, we're good. It could be worthwhile. In the whole life space, the growth isn't going to be based on an index. The growth is going to be based on a dividend. We're generally going to look at and basically only utilize mutual companies where we become a part owner of the company when we own a whole life policy with that company. So we get to participate in the dividends of that company, the profitability. Well, insurance companies are really good at making money. Not outrageous amounts of money. They're not going to make 30%, or they're not going to make enough that they can pay a 30% dividend in any given year. But essentially, they're going to consistently kick off 5-6% dividends year after year after year. And if we can get a properly designed policy that's established for high cash growth, we're going to minimize those expenses in it, and most of the money we're putting into it is going to turn into cash value, and we're going to see growth in it. Now, the advantage to life insurance, well, let's start with the disadvantages. The disadvantage to using life insurance is you have the expense of life insurance, okay? In the early years, that expense compared to what you're putting into it is going to be a high percentage, maybe 10 or 20% in that first year, even for a really good design, right? The amount of cash value we'll have available might be 10 or 20% lower than what we've put into it. Well, the expenses basically hold steady, but we continue to put more and more money into it. So as a percentage, those expenses get smaller and smaller and smaller. But the amount of money we're going to earn inside the policy gets bigger and bigger and bigger. So the downside is the expense, but that's just the cost of doing business. When we're talking 529s, those have expenses as well. The portfolios that we're using have expenses as well. Some of those are very good expenses. We might be looking at a 1% or possibly even less on some of the low-cost options. But there is still an expense there. So we're not going to get away from an expense. Let's just put it that way. The expense is likely going to be higher in a whole life policy than it will be if you're in some type of a mutual fund or ETF inside of a 529 plan. Likely going to be more expensive. Now, the expense inside the life insurance, though, doesn't go up as the value goes up. Whereas the expense in the 529, it will go up. So depending on how much you're planning on funding these things, we could see it flip to where it's a lot more expensive in the 529 plan than it is in the life insurance after a number of years. Now, the reason for the life insurance. Cash value in life insurance, whether it's whole life or IUL, it doesn't get reported on the FAFSA. It doesn't get included in the income or the net worth for the purposes of determining whether your student can qualify for grants or loans or student aid. So it works out to be a pretty good deal. It can significantly reduce what you might be required to pay to attend a college. In addition, we don't have to worry about the mix of the portfolio. It's just going to continue to earn those steady returns. We don't have to, in the case of whole life, there's not an aggressive period and a less aggressive period. We don't have to take any risk off the table. So there's value in that. The growth is happening, tax deferred. When we get to college, we might just leave the money inside the policy and take student loans out, especially, and this has happened in the recent past, if you have access to student loans at 0% interest while they're still in school. When they end up getting out of school and now the interest kicks in, that's when you look to borrow from the policy in order to pay the loan. And now we're carrying the loan from the value in the policy instead. Now, you don't have to take a loan from the policy. You can just withdraw the money if you want to, but there's a good reason to just borrow it. It's a fixed rate. A lot of times it's a fixed rate. It's a very low rate in nearly every circumstance. And when you pay that loan back, that money is available to borrow again. And you can do that and utilize that cash value throughout the rest of your life. Or if you give them the policy at some point, they can use it throughout the rest of their life. It's going to depend on who the insured is on the policy, because the insured may not be the student. It may not be the child that you're trying to get that college fund set up for. The insured might be a parent, okay? But whoever owns that policy can continue to use it even when the need for education funding goes away. There's a lot of value in that. And obviously, this kind of goes without mention, but we are talking life insurance. If tragedy were to occur at any point before college or even after college, there's a death benefit that's going to pay out, and that death benefit is going to be a multiple of whatever was paid into it. If you got money in a 529 account and that person dies, whoever's funding it dies, and that's going to pass on as part of somebody's estate, it's only that exact dollar amount that's going to pass on. There's no extra like we get with life insurance. So there's actual value in having life insurance itself, but when we do a proper design on a life insurance policy, a cash value life insurance policy, we get a lot of other benefits that just make it more and more worthwhile to use as that funding instrument. So I have no issue with using whole life as the alternative to a 529. I would recommend to look into the tax advantages that you have in your state for contributions to a 529. There could be a good argument to at least contribute a little bit to a 529 and take advantage of some of that, and maybe consider contributing to a cash value life insurance policy, either in addition to it or in place of your other efforts that you might make so that you can properly fund some college education. If you have any questions about anything we talked about here, or you have any insight, or maybe you're doing something different, leave it in the comment section below. I'm certainly always trying to learn more than what I know now, and willing to be exposed to new information so that we're always trying to maximize our cash flow and do the best that we can with the financial portfolios that we're creating that are going to help us later on in life.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.